Netflix did not blow up this quarter. The company reported strong numbers, and that is exactly why the market reaction matters. Revenue came in at $12.56 billion, up 13.4% from a year ago. Operating margin was 33.4%. Management still expects full-year operating margin of 31.5%, and it lifted the free cash flow outlook to about $8 to $8.5 billion. On the surface, this is not a broken company. It is one of the most profitable media businesses in the world. But the stock was not trading only on this quarter's income statement. It was trading on the story investors had been paying for. That story is changing. Netflix used to be valued as a high-growth streaming platform with a long runway of subscriber expansion. Today, the market is asking a different question. Is Netflix still a growth company, or is it becoming a very profitable, mature entertainment company? That difference matters because the same profit can deserve a very different valuation depending on the growth behind it. Start with revenue growth. First quarter revenue growth was 16.2%. Second quarter revenue growth was 13.4%. For the third quarter, management guided to about 11.7% growth. That is still growth. But it is a step down. When a company is priced for a long growth runway, the market does not wait for the business to collapse. It reacts when the slope begins to flatten. The next piece is engagement. Netflix said viewing hours in the first half of the year were above 97 billion hours, up 2% from a year earlier. 97 billion hours is enormous. The problem is the growth rate. A 2% increase in viewing hours does not sound like the engine of a high multiple growth stock. This is why the disclosure change is sensitive. Netflix said its What We Watched report will move from twice a year to once a year, starting in 2027. Management's argument is clear. Viewing time is not the full business, and investors should focus on revenue and operating income. That argument is financially reasonable. But it also raises the trust burden. If Netflix wants the market to believe the growth story, less public engagement data means investors have to rely more on management's internal framing. That becomes more important because advertising is now a major part of the next growth story. Netflix expects ad revenue to roughly double in 2026 to about $3 billion. It says ad revenue can double again in 2027. That is a real business line. It is not a side project anymore. But advertising does not just buy video inventory. Advertising buys measurable attention. Advertisers want proof that people are watching, that campaigns are working, and that the audience quality is worth the price. So Netflix is trying to do two things at once. It wants investors to care less about viewing hours as a public metric. At the same time, it wants advertisers and investors to believe that its attention base can support a much larger ad business. That tension is one reason the market is more cautious. There is also a pricing story, and this is where Netflix still looks strong. Management said retention after price increases was in line with expectations. It also said retention improved year over year in every region. That is important. A media company that can raise prices without heavy churn has real pricing power. Pricing power is why Netflix can keep margins high. It is why the business can generate serious cash. It is also why the company can invest in live events, games, podcasts, and artificial intelligence without destroying profitability. But those projects are not yet strong enough to replace the old growth narrative by themselves. Live sports and live entertainment can create event moments. Games can extend the product beyond passive viewing. Podcasts can feed discovery and intellectual property. Artificial intelligence can improve production, recommendation, and localization. All of that matters. But investors still need to see whether these projects can move the revenue line at the scale of Netflix's core business. That is the central issue. Netflix is not being punished because the company is weak. It is being repriced because the market is less willing to pay a growth company multiple for a business that increasingly looks like a high-margin media compounder. That is a much more subtle shift, and it is easy to miss if you only look at whether the quarter beat or missed expectations. The quarter says Netflix is profitable. The stock reaction says investors are debating what kind of company Netflix is becoming. If revenue growth keeps stepping down, if engagement growth remains low, and if public disclosure gets thinner, the market will demand more proof from advertising and new formats. If advertising scales, pricing power holds, and new content formats expand attention, Netflix can still defend a premium valuation. But the burden of proof has moved. This is no longer just a streaming winner story. It is now a valuation transition story. Netflix did not blow up. The market simply stopped treating strong margins as enough proof of high growth.